If you look at Wall Street from the outside, it looks like pure chaos. People shouting, numbers flashing, screens everywhere. But underneath all that noise, the financial market is actually incredibly organized. In fact, it works a lot like a normal grocery store. Think of it as a giant supply chain. A supermarket takes raw ingredients from a farm, processes them, and puts them in a shiny box on a shelf. The financial system does the exact same thing with money and risk. When you finally buy a box of cereal off the shelf, or in this case, when you make a trade, you're simply handing money to someone else in exchange for an item. That simple movement of money from one person to another is called cash flow. And the specific item you're buying, the barcode on the box that gets scanned at the register, is called an instrument. Every single stock, bond, or options contract you hear about is just an instrument sitting on a shelf, waiting to be traded. But how does that item actually get made? It follows a strict path. It starts at the very top with broad categories called super asset classes. Those are broken down into regular asset classes, then packaged into specific products, and finally, they become the individual instruments you buy and sell. So to really understand what you're buying at the bottom, we need to look at the top. The entire global economy is built from just 3 super asset classes. They act as the raw ingredients for everything else. The first and most important ingredient is called the underlying. This is the foundation of the market. It represents independent value. The purpose of an underlying asset is very grounded. It either funds a business or supports the actual production and consumption of goods. There are exactly 5 types of underlying assets. We have money, bonds, equity, Forex, and commodities. These are tangible things. A commodity is a physical good, like wheat being pulled from the earth, or oil. Equity is literal ownership in a functioning company. These 5 base elements can be grouped together. If you combine money and bonds, you get debt, which is just lending. If you take that debt and add equity, you get capital assets. Now look at Forex, which stands for foreign exchange or global currencies. In the past, currencies were strictly tools for buying goods across borders. But once global exchange rates were allowed to float and change daily, those currencies became an investment of their own. You could buy euros, who may become more valuable than dollars. Everything starts right here. These underlying assets generate all the real-world value. Without them, nothing else in the financial system can exist. Because those underlying assets carry risk, like crop prices dropping or companies failing, Wall Street created a second super asset class to deal with it. These are called derivatives. A derivative does not have any value on its own. It derives its value entirely from what the underlying asset is doing. This diagram shows exactly how they match up. Every underlying asset has a specific risk and a corresponding derivative to manage it. Equity carries price risk, so we use equity derivatives. Foreign exchange carries currency risk, demanding Forex derivatives. There is a common misunderstanding about how these work. Because derivatives are strictly used for managing risk, they are always simple buy and sell trades. You can never borrow or lend a derivative. The third and final super asset class is structured finance. This is where financial engineers combine underlying assets to do 2 things at once: raise money and manage risk at exact same time. This flowchart shows how that engineering happens. Notice the dotted line mapping debt over to structured credit. That represents a process called securitization. It is a fancy word for a simple idea. A bank takes thousands of individual loans, pulls them together into one giant package, and sells that package to investors. This block diagram brings the entire ecosystem into focus. The underlying layer creates the value. The derivative layer manages the risk of that value. And structured finance takes both and engineers them into new tools. Now that we understand those 3 massive ingredients at the top, let's walk back down the aisle to see what you actually buy. Below the asset class, we find products. A product is simply a subcategory grouped by specific features. For example, within the equity asset class, a company might offer different types of shares, some that give you voting rights and some that do not. Sometimes we need an even deeper level of sorting, which gives us sub-products. You usually only see this extra layer of classification in more complex areas like equity, derivatives, or structured finance. Finally, we reach the bottom of the chain, the instrument. This is the specific individual item with its own unique identifier. Whether it's a single share of a tech company or a specific government bond, this is what you actually put in your cart and trade. When you trace this path, the financial jargon loses its power to confuse you. You can look at any complicated investment and know exactly where it sits on the shelf and which raw ingredient it was made from. Handling the massive volume of global trading requires a property called fungibility. It is essentially a test of interchangeability, determining if two different financial instruments can be treated as the exact same thing. The standard is strict. If two items are identical in every detail, they are interchangeable. But if they differ even slightly, the market treats them as separate, unique instruments. Take two government bonds known as treasury bills. The first is a 180-day bill that was issued 90 days ago. The second is a brand new 90-day bill issued today. Even though they were issued at different times, look at where they are right now. Both bills have exactly 90 days left until they pay out. To the financial system, they are now the exact same instrument. You can trade one for the other without a second thought. So the next time you hear about a complicated market move, remember the grocery store. The whole system is just a carefully organized chain. It starts with the real-world underlying value. Once you understand that base layer, the rest of the financial world makes perfect sense.